your own research. Those are the conversations you end up hearing from analysts, especially senior analysts like who I have joining me in good for this episode of In Good Company. And what does it mean to do your own research? You need to understand the fundamentals of a particular company before investing in that company. It's just like buying real estate. Before you end up buying a particular real estate, a piece of real estate, you need to go check out the foundation, check out the structural piece of that particular real estate and know if it's worth your bucks. And that the same thing applies to investing in the capital market and the stock market. And that's what it means by doing your own research. And joining me to have this conversation, because today we're taking a look at we're examining and x-raying a particular company listed on the floor of the NGX in 1998. It's called UPDC. It used to be a department in UAC, and right now is listed on the floor. It's a property development company. They are also into sales of property. Now, joining me for this conversation is Idika Aja, who is a senior financial analyst. You're very much welcome to In Good Company, Idika Aja.
Yeah, thank you very much, Frank. It's good to be back.
Okay, so what's your take about UPDC? If we look at their price is surged by 77% year to date, from beginning of this year to now, 77%. A lot of people are asking, what is this? Does this reflect strong fundamentals as regards their numbers?
Yeah, first, UPDC, normally in Good Company, we look at the companies that are doing very well on the exchange.
Very true.
And right now is the third best performing stock on the NGX.
77%.
At 77%.
Yeah.
In 2023, it did 41%. And in 2024, I think about 24%. So it deserves the attention. Yes, fundamentally, UPDS has done very well. Revenue grew by, I think, about 123% to 11 billion, almost half of what they did in 2023.
Yeah.
Then gross profit, I think they recorded about 4.3 billion in gross profit down the line. So, yes, in terms of fundamentals, they have done very well.
Yeah.
But I think the issue there is the valuation at price-earning ratio of 40 or 44 or 40. Raises,
so a lot of people are asking that.
Whether it is
is it not too high?
Whether it is high or not.
Yeah.
So it's something that we need to look at. Yes, but fundamentally it has done very well compared to what over the past 6 years, the revenue growth is the highest in 6 years. Profit after tax, the highest in 6 years. Profit before tax, the highest in 6 years, and even earning per share, moving from 1 kobo in 2023 to 7 kobo in 2024. So fundamentally, it has done very well. But the aspect we are looking at is the valuation. Of looking at its valuation using the price-earning ratio of 40. That means it's telling you that...
it's a premium.
It's a premium that investors are ready to pay more, maybe in expectation of future growth. So that is what it means.
Okay. But if you look at... they've been having consistent growth, and it's the highest they've ever had in their revenues. You just talked about it in 6 years. They've doubled that. But the big question now is, how sustainable is this? How sustainable is this growth? Because I always look at investment like it's a marathon. It's not just a sprint where, you do 6x revenue in 6 years, just one-off in the market. Can they sustain the growth so that a lot of long-term investors will pitch their tent around that particular around their stocks?
Okay. It's not. Yes, it is good that whether to ask that question whether they can sustain the growth. But as it is now, looking at their performance in 2024, it is not the question of whether they are going to sustain it. It is a must. They must sustain it. Looking at what the market is looking at the product, they are signed because they are giving the company based on its the share price and the earning. Over the past 5 years, I think they have declared loss in 3 years out of the 5 years.
Yeah, they did.
So now this 2024 was a wonderful year for them, and they have to sustain it, because if you look at when you look at in isolation the price earning ratio, it seems that it is high compared to peers. That means investors are pricing it higher compared to EPS.
Yeah,
but when you look at the price earning growth, when you bring in the price earning growth, which I think the earning per share grew by 600%, which is very, very solid, which is very, very high.
Yeah.
Then if you compare it with the price earning ratio, we're having about price earning growth of about 0.007, which makes the stock looks undervalued.
Sure.
So in the case of being or sustaining it, it's just a must because they have to sustain it. If they don't sustain it, it will not give value to that valuation, to what investors are looking at it.
Okay.
So it's a must that they have to sustain it.
So their gross margin has improved significantly, and their profitability is still a little bit modest. And a lot of people are asking that, what is really holding UPDC back? What's holding them back as regards their profits?
Okay, as regards the numbers, yes, the gross profit margin, I think they did about 36% in 2024 compared to the negative 41% in 2019. Now, that is on the top line, direct cost. They did very well. That is meaning they did very well to record about 36% gross profit margin. Now, down to, if you look at the operating profit margin, I think they did about, you have about 15%, which is relatively good. Now, I think why you have the 11% net profit margin is because of tax issue. Because even the pre-tax profit margin is still okay at, I think, about 14%, and there is a growth.
Yeah.
I think 7%, 14%. You can see that they did very well.
Very true.
Now, I think the problem where they have, why they have that 11% is because of the tax-related issues, because they have to pay about, I think, about 528 million in taxes, which actually reduce their net profit and consequently the net profit margin. So it's tax-related issue. For me, normally we look at the pre-tax profit and margin, which is to an extent okay.
So UPDC is really big on property development, and with this rally that we've seen, 77%, how much of it is tied to their recent project, the Brompton City project? How much of this rally is tied to that?
Yeah. If you look at let's take the total revenue.
All
the
right.
total revenue is about 11 billion. Like I said, it's almost half of what they did in 2023. And out of that 11 billion, 88% of it comes from their real estate development.
88%?
Yes, 88%. Even the hospitality sector, I think, recorded about 1 million revenue mark, which is still impressive.
1 million?
Well, yeah, 1 million.
Okay.
Now, the revenue, the Brompton City Estate, I think they realized about 5.2 billion from it. You know, it's a 30-hectare size project. And it's still under...
Very massive.
Very massive, and it's still at the initial stage. So it gave them about 5.2 billion revenue from that. So I think that is what investors are pricing in because of the expansion and what they are seeing. Maybe they are hoping that, okay, the UPDC will continue to grow, expand, and continue to make money from their property development. Even apart from that, from their normal property, they made about 4 million against 4 billion against 1.something billion in 2023. So I think the property development segment of it is giving them real money, and I think it's okay.
So if you look at UPDC's low free float of 4.89%, do you think it will affect the stock's volatility?
Yes. You know, another thing you have to consider for investors who want to invest, you look at the liquidity.
Yeah, the liquidity.
And liquidity
very
at
important.
times is being controlled by the free float. As a matter of fact, it is NGX requirements. If you go to NGX, I think rule 2.2 B4 I think A and B, it says that for listed companies, the free float should be about 20% of issue share capital, or 40 billion, and their own is about 4 point something. So it is just telling you that the shares are tightly held. You understand? So, and at times, if you want to exit, you may not, as investor, want to exit, it might not be that easy for you to exit. Yes, it is a minus for them. I think they mentioned it that they are trying, they are doing everything to ensure that they meet up with that NGS requirement. It is a requirement, and you must adhere to it.
So let's pivot a little bit into macroeconomic. If you look at the macroeconomic climate, especially in our country, with what is happening with MBS, the whole idea of what is it called? With the whole idea of them rebasing of the GDP, inflation rate, and because of rebasing of the GDP, you're seeing that real estate is getting a whole lot of attention. And as a matter of fact, because of GDP that is going to be rebased, real estate is said to be the largest industry, the largest sector in Nigeria as we speak. Do you think that this will bring about a massive growth in UPDC because they play in the real estate space?
Yeah, in the real estate sector, there are macroeconomic factors that really affect them.
Very true.
And one of them, you look at the inflation rate. If the purchasing power is not good, it will affect people buying into buying into it. Now you look at the interest rate. You understand if the interest rate is high, of course their borrowing cost will be high.
Very true.
But they have done very well. I think their interest expense dropped from 430 something million to 330 something million. That equally increased their interest coverage ratio from 1 to 4.2. That means that their earnings before depreciation and so on is very okay, that they can cover their interest expense. So it is okay. But at an interest rate, because the CBN released their data and they still retain that MPR at 27.5. That means that we should expect more high borrowing costs, and which the long run will equally affect them. You understand? It will affect their cost of borrowing, which, because real estate requires massive investments.
Capital intensive.
It's capital intensive, and it requires massive capital. It requires capital. And with the present MPR, definitely it might affect them. I think that is the headwinds I see that might affect them.
What if we have some rate cuts? What if we experience some rate cuts? Let's say the next MPC meeting was seeing 50 basis point rate cut from the MPR. It won't be a good one for them?
Sure. The real estate is a cyclical business.
True.
So it goes with the microeconomics and how the economics moves. Now, if they bring down the rate, definitely their cost of fund will come down.
True.
You understand? Because they need this. Because I looked at their balance sheet size and look at their equity. You understand? So if the interest rate comes down, definitely it will be of benefit to them. And the inflation rate is down, but that has not really, it's not going to translate to the required purchasing power where the ordinary man can equally afford. Because I looked at especially the Brompton City project, and I think when you calculate give and take, they are selling a plot about 82 million. A plot there, that's what is, and that is a 30 hectare size project. That will look at maybe about 1,000 plots. So give and take on the floor spread at floor basis, maybe they are looking at maybe about 82 billion, which they have generated 5.2 billion. So you still have a gap. But the thing is that will they be able to meet up based on the purchasing power? So that is where the macroeconomics factors come in.
Buy, sell, hold. Which of them are you doing? If you were to be in the shoes of an investor. So I want you to change your portfolio right now to be to an investor rather than an analyst.
Yeah, you are right, because the most important thing for an investor, the essence of investing. I know people have been asking, what is my return or ROI if I invest? Like now the thing is giving you 77% the debt. That means if I've taken a position in January. That's theoretically your return should be 77%. That means if you want to sell.
That's way above NPR.
Yes,
way above inflation.
Way above inflation rate, which is good, and number 3 on the NGL, which is very wonderful. But yes, there are certain things you check for an investor to know whether to buy, hold, or sell.
Okay.
One, at least you go into investment to be able to make return. Right now, it is not a dividend-paying stock. I just hope they will declare dividends. So we rely on the capital gain. And the capital gain is 77, so it might come down, it might go up. But the factors that favor you holding it, you understand. One, their expansion in the real estate development. I think they have a good growth there. They are expanding, and they not only even the Brompton estate, they have the Hampshire, which is a 5-hectare size project. Then they have another one in Calabar, which they are trying to develop. So for an investor that can take that risk, that believe in that, I think you can buy. You understand? Then for risk-averse investors, you can decide to look at the macroeconomic factors which I have mentioned. You understand? And at the same time, you look at their low free floats, which can equally restrict liquidity. So on that note, you can decide to be cautious. You understand? So that is my take on that.
You've heard from a city gentleman, Idikaja, who's a senior financial analyst. He's broken down the numbers and explained what it means for you to either buy, sell, or hold UPDC, which is the only, if I'm not mistaken, I stand to be corrected, which is the only property development company listed on the floor of the NGX. Am I correct?
Well, unless I check the record, you have
the last time I checked.
Most of them you have Union Homes. They are there. Then some of them operate as a real estate investment trust fund.
Yeah, true.
So instead of you investing like buying this property, just like a trust fund, you can equally buy through them. So you have Union Homes. You have even I think you have UPDC real estate investment trust fund, which is equally listed.
That is it on this episode of In Good Company. I'll see you on the next episode. Make sure you like, share, subscribe. My name is Frank Fagbot. Do have an amazing time. Cheers.